Good day. We are the Group 4 assigned to report about the depreciation concept and report and financial result. I'd like to introduce our Group 4 member, Asis Precious Jamie, Martin Sherry Ann, Reyes Carlo, and yours truly, Tamera Marco. The depreciation concept. Depreciation defines as depreciation expense spreads or allocates the cost of fixed assets over the useful life of that asset. It is also the cost of equipment allocated during their useful life, meaning it's a gradual decrease in the value of an asset over time due to factors such as wear and tear, obsolescence, or expiration of its useful life. But before we proceed to the depreciation method, let's first define some terminologies to remember, such as fixed assets, depreciation expense, useful life of the asset, salvage value, reserve for depreciation or accumulated, and the net book value of a fixed asset. Fixed assets, also known as long-term assets, are classified as long-term and placed on the balance sheets, such as they will not be converted into cash in the coming 12 months. Ang example nito is yung building, equipment, land, and computers. Next is the depreciation expense, defined as when the cost is spread or allocated over a period of years. Each year's financial statements recognize some portion of the cost. Meaning is, yung depreciation expense meaning is yung pagdidecrease ng value ng isang property or assets because of the passage of time and use. Then next is the useful life of the assets. The useful life determines the period of over which the fixed assets cost will be spread. Ang example nito, yung example is yung piece of equipment purchased natin kunyari ng 20,000 and it has a useful life of 5 years. So, nagdi-depreciate ang expense niya for each of the 5 years until it use up. Salvage value, also known as residual value or scrap value. It is the expected cash value of the assets at the end of its useful life. Bali, ito yung recovered ng isang assets kung magkano yung natitirang amount ng assets after useful life. Next is reserve for depreciation or accumulated. Depreciation expense over the years is accumulated into the reserve for depreciation. These are funds established by a business for expensive items that depreciates over time and must be replaced. Bali, accumulated depreciation is the total amount of wear to date. Ito yung magkano yung yung accumulated na dinidepreciate ng assets after 5 years. This table explains that the depreciation expense is recognized on the income statement. Bali, sa income statement pumapasok ang depreciation expense, while the reserve for depreciation are accumulated, sa balance sheet naman siya pumapasok. Capital expenditure is a purchase of a fixed assets. Funds used by a company to acquire, upgrade, and maintain physical assets such as property, plants, building, technology, or equipment. Capitalizing means recording these assets as long-term assets on the balance sheets. Next is the net book value of a fixed assets. The net book value, also known as the book value of a fixed assets, is a balance sheets figure that representing the remaining undepreciated portion of a fixed assets cost. The net book value of a fixed assets is computed as follows. First, determine the original cost of the fixed assets on the balance sheet. Then subtract the reserve for depreciation, which has accumulated depreciation expense as it has been recognized. And the result equals is the net book value at that point in time. Here are the methods of computing book depreciation. Number one, straight line depreciation method. Second, the sum of the year digits method or SYD. Next is the double declining balance method or DDB, and the 150% declining balance. And lastly, the units of service or unit of production depreciation method or UOP. There are three methods categorized under the accelerated depreciation method, which are the sum of the year digits and the double declining balance, and lastly the 150% declining balance method. The straight line depreciation method is a sign of an equal or even amount of depreciation expense over each year of the asset's useful life. The expense is thus spread evenly or in a straight line over the life of that assets. This table explains the computation of a straight line depreciation of a 5-year life assets with no salvage value. The expense is spread evenly in a straight line over the life of the assets. Depreciation applied to a fixed assets costing $10,000 with a 5-year useful life and no salvage value. The depreciation expense thus equal 2,000 for each 5 years, and 10,000 is divided by 5 is equal to 2,000 per year. This table is also a straight line depreciation with a 5-year life but with salvage value. A salvage applied to a fixed assets costing 10,000 with a 5-year useful life and the 1,000 salvage value. The depreciation would thus equal 1,800 for each year because we must leave at the end of the year. We must leave 1,000 at the end of the year. So 10,000 less 1,000 equals 9,000 divided by 5 equals to 1,800 per year. The next is the sum of the year digits or SYD method. It computes the depreciation by multiplying the depreciable cost of the assets by a fraction. The sum of the year's digits method is a fraction mechanism by which the acceleration is computed. The numerator of the SYD fraction starts with the asset's useful life expressed in years and decreases by 1 each year after. The denominator of the SYD fraction is the sum of the years digits of the asset's lives. In this table, the depreciable cost of 10,000 is divided by 15 to arrive at 666.66, and it's multiplied by 5 for the first year and by 4 for the second year, and so on. The double declining balance accelerated depreciation method, or DDB, computes depreciation by multiplying the asset's net book value at the beginning of each year by a constant percentage or factor. A constant factor is twice the straight line rate. This method is used for the assets that are quickly lose their value or inevitable become obsolete. This table of the double declining factor illustrates the computation for each year of a 5-year useful life with no salvage value. A 10,000 cost of fixed assets divided by the asset's useful life for 5 years equals 20%, or a factor of 20.20, multiplied the, the 0.20 by 2 or doubled to arrive at a 40.40 double declining factor. Next is the 150% declining balance method. It computes the depreciation by multiplying the asset's net book value at the beginning of each year by a constant percentage or a factor. A constant factor is a half again, or 150% of straight line rate. This common method used for a property depreciation. This table illustrates the 150% declining balance factor computation for each years of the 5-year useful life with no salvage value. A 10,000 cost of a fixed assets divided by the asset's useful life for 5 years equals to 20, or a factor of 0.20. Multiply the 0.20 by 150%, or a half gain, to arrive at a 0.30% of 150% declining balance factor. The factor applied is 0.30 per year, and the 150% declining balance switches to straight line in year 3 instead of year 4. The depreciation by multiplying the asset's net book value at the beginning each year by a constant percentage or a factor. Tama. Units of service or units of production depreciation method. It is an asset that computes depreciation by assigning a fixed amount of depreciation to each unit of service or output that is produced by equipment. This table illustrates the units of service or units of production depreciation in 5 years of service with no salvage value. The total depreciable units of service over 5 years are determined to be 5,000 units. The equipment cost to be depreciated of 10,000 is divided by 5,000 units to arrive the depreciation of a $2 per unit. A unit of service in 1 year total is 1,000 times 2 per unit equals 2,000 depreciation in first year, and the second year is 900 times 2 is equals to 1,800 depreciation in the second year, and so on. Computing tax depreciation. Tax depreciation means depreciation that is computed for tax purposes and is reflected on the applicable tax returns of the organization. The modified accelerated cost recovery, or MARCS, is a current used to depreciate most business and investment property for tax purposes. There are two methods of tax depreciation in effect at the time of its writing fall under the modified accelerated cost recovery system. These are the general depreciation system and the alternative depreciation system. The next table given is an example for a property tax depreciation computation, which is not really discussed uh, on the reference because it's only used in the USA. Ang alam ko kasi iba yung tax computation regarding sa different states. Ayun po.